Hey everybody, Bob and Phil here, Trade Genius, another one of our podcasts. If things are so great, why is this happening? Stay tuned.
Trade Genius.
Hey guys, really briefly before we jump into this video, appreciate all the likes and subscribes, and if you can ring that notification button, that really helps us out. In addition to that, if you guys don't mind, head over to tradegenius.co, check out our specials we have over there. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live, and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that.
All right, Phil. You and I are pretty connected out there to our subscribers, our audience. We get the constant refrain back to us by the doubters is everything's fine, everything's fine, everything's fine.
Right.
And we're telling you guys that basically you may be walking on ice, but it's thin underneath you. Here's a chart that's going to probably make you cry because it is crumbling beneath us, and it's bankruptcies. And bankruptcies in 2023 are breaking out, I think, the highest in 10 to 12 years. And you want to throw a chart up there, Phil, and kind of walk people through this?
Yeah, so here's your bankruptcy filings by the year. Now, we're over here in 2023 just getting started. I know the bar there is a lot shorter than the rest, but that's because we're only year to date. Focus on the blue area, and our blue area is beating everything out except for 2010, and 2010 was coming out of the worst financial crisis we had seen in a very long time. And we're just getting started in this year. 111 U.S. bankruptcy filings already. We're racing higher here. To put this into better perspective, you can look at it by the month, and you can see here, and this is what's really telling. Here's your first quarter of 2023. Huge jump to start the year off. And if you scroll over to where we had another spike like that, if you look over in June and July of 2020, that was COVID. Literally everyone's business halted in its tracks. Smaller businesses could not survive. And here we go. We're pushing up into those levels quickly. I know yesterday's video and today's video, I think it becomes very clear that we're seeing the data almost as if we're in a pandemic type setting, but we're not in a pandemic type setting. It's just the economy is just out of gas.
Yeah, doesn't it feel like everything is at pandemic levels except for stock price?
That's exactly right.
It's amazing to me. Sometimes you question your sanity here, and then you start seeing all this data coming out. And you got to remember, the last thing most people want to do is to declare bankruptcy because it's a point of pride. It's a stigma. Mm-hmm. But, all they keep doing is just grinding people to death. And I was just in Washington, D.C. yesterday doing kind of an East Coast, north to south swing here, seeing family and friends, and ran into a really old friend of my wife's. And they were talking, and she's basically saying that they're just wiping out the small business owners in D.C. itself because they just keep jamming the rents, because the companies that own all these properties now aren't mom and pop owners anymore. They're corporate owners, and they're just formula driven, and they don't care if these things go empty. And then once you lose your location, you lose your business and you shut down. And I think we're seeing that across the board, and I think it's a problem. But that's just an aside. Let's go back and show people too, Phil. If we get back to the stock theme for a second, this is something you track really, 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 really well. I think people really pay attention to this chart. This is one of the things that Phil has in his newsletter, and this way he keeps people on the right side of the trade. And Phil, before you kind of explain the pennant, can you explain really what this chart is and what it's all about?
Yeah, so basically, let's switch over to that chart. So what this is basically, it's how many stocks in the S&P 500. This is just looking at the S&P 500, and we're looking at it down here on this part of the graph down here, because as you can see with most, if you're familiar with stock indicators that oscillate, if you go up to the top of the range, that's usually pretty bearish. It means that the move is exhausting. And likewise, if you go to the bottom of the range, it provides decent buying opportunities, either for a quick bounce or a longer term bounce. This is just one thing we look at, but what this does is it tells us how many things are overperforming versus underperforming in the S&P 500. And we came up and hit the overperforming mark, and you can zoom in there and see there's 2 red days. Okay, so at the end of the day, even though we might be over our skis relative to what's going on under the hood, and there's a reckoning coming, the shorter term stuff, you can kind of pinpoint these moves. And especially when you see the momentum going up, okay, well, the market's going to do what it usually usually does, and that's going to swing up. But when we get to these levels, if you notice, when we get to these red areas, it gets hard for price to just keep zooming higher. Now, we look at a couple of other things too, just aside from this, to let us know where we are in a larger cycle, because what we like to do is focus on when the cycle gets stretched up to here and up to here and up to here, all the while it's syncing up with this. But the point being is that we're up here again, okay? And so for those of you that are thinking, oh, we're going to go back and run to the highs, that's just not happening, because, I mean, if you look at every time we've gotten to these levels, it stalls price out here, stalls price out, we made one more high and then big pullback. The risk is these big pullbacks from these moves. And lately in this last series of things, we've been going up, holding a trend line basically, and then we start to collapse under. There's 3 moves here, and typically in the market, when you get 3 moves, usually it doesn't happen the fourth time. The fourth time breaks the cycle or the pattern. You see that pattern of 3 a lot in the markets. So couple that with, we're at the top of this pennant, and because it's a pennant, you look at like the move that brought us down into this pennant. Well, the move was down, so pennants usually break in that same direction down, and then that takes us probably to the lows. So we wanted to show you this again. This is one piece of what we look at, but being that we're at basically the top of another cycle, and we're going into like a new 40-day cycle. These are all things that we cover in the newsletter. You be very careful here. This market has lulled a lot of people to sleep, and this is where you need to be getting defensive. And I would be very thankful that we're even up here at this point, considering what's going on in the real economy.
Yeah, I mean, I agree. An economy that is expanding would be making consistent higher highs that are observable, not walking into a wall,
right,
and falling and hitting a wall and falling. That you're seeing there is big money using these lifts for liquidity to lighten up position size. And one thing too is that I'll find the article, well, maybe we'll do it this week, is that retail has been picking up the slack. Retail's been buying the bank stocks.
Yep.
I mean, you just want to shake people's heads.
Yep.
No. Stay away. They basically told you guys, buy this dip, and they basically sold it to you.
Yep.
So that's, you got to be really careful, guys, on this stuff, is these are kind of things get you on the right side of the trade. And Phil knows too, sometimes you get exuberant, because, and we were talking about this offline, and I get guilty of it myself too, is that you're so mad at the leadership of the country that you trade that way. And that's not how markets work. So, you always want a revenge trade. These stocks, they shouldn't be going up. I'm going to go ahead and I'm going to short this. And then Phil has to get on there as the voice of reason to say, guys, you can't short it when the performance levels are rising. You got to wait for it to get extreme, and then you can go ahead and short the market. Or when it's at the bottom, people want to short it because they feel like, hey, I got to short this thing. It's falling. I'm missing the move. And that's called shorting into the hole.
Yep.
And usually what happens is you get a hole in your wallet.
Yep.
And I share these things not because I'm any smarter than anybody else. It's that I've learned from bitter experience that sometimes you got to let go of your emotions and see what the market is telling you through these charts, and just say, okay, the easy move, I already missed it. You got to wait for it to set back up again, or reverse it and trade back in the direction it's going. So, trading and economy and politics, they don't always align. And you really have to just focus on what the money is doing. And you can still hate the deep state and things like that, but just don't trade against where the market's taking you.
No, I agree. And if you even look at the time frames on this chart of where we're at the lows versus the highs, if you remember back going into October, the sentiment online, the sentiment from our comments was very bearish. Then when we get back to the highs going into like the end of the last year, the comments were like, bear market's over, and it's like every time we pull back, it's like, oh, here we go. And then every time we get up to the top of these troughs, it's the market's ripping higher, nothing to worry about. And Wall Street knows this. They play into that. They rely on retail to buy the wrong areas. They rely on retail to get positioned down here at the bottom to go short, and they rip them off and they rip it higher. And so it's, again, I think you can look back at even maybe the sentiment you see on Twitter. When you see an overwhelming sentiment on Twitter, I can pretty much guarantee you that 9 out of 10 times the exact opposite will happen. Okay. So it's just the way markets work. People get on one side of the boat, the boat capsizes. It doesn't mean that they're wrong. It's just that you can't be that weighted to one side in that amount of time. You're going to get an opposite reaction. It's almost like it's just a balancing act that constantly happens. So this swinging up and down here is a balancing act. We're going to roll over and we're going to get imbalanced to the downside, and then we're going to have another corrective wave higher. It's just the way these markets go. But if you zoom out, we're not going higher. We're going lower, and people get lost in that narrative of, things are fine at the top of these little cycles, except, what they should be doing is saying, thank you very much, exit stage left, and then wait for it to roll back over and then do the same thing. But they don't. Retail gets emotional. They think it's not going to stop. And it just happens over and over and over again. But that's why we like to point these things out. So you know that, hey, the turns are here.
Yeah, look, I mean, these guys have 50, psychologists, PhDs on their staff building these algos. Humans are the best at creating narratives, right? So when things are going well, I can argue the economic prosperity. Hey, the restaurants are full. I couldn't get a flight, and things are bad. Hey, it was really bad. My friend lost his job. You're really good at stuff. And really all it really comes down to is there's very few things that move the market, price, volume, and range, right? So, yep. and so you just have to kind of look at those things. And can you be wrong? Sure. But you're going to be wrong at a much lower rate,
yep.
On the failures versus basically trading outside back in on these things. So that's why we point these things out at you. We're helping you with the macro because we're showing you the data. We're not showing you just, our feelings on this stuff. It's coming. And so guys got to be really, really careful. And these bankruptcies, they're just starting, guys. They're literally just starting.
Yep. And at the end of the day, it's liquidity that drives this. And, like we said, that's one piece that we look at. The other piece is liquidity. And there was a big argument whether or not the liquidity provided to these banks would cause the market to go up. And we kind of lean on, until we see otherwise, liquidity drives the market. And that's why you've seen this move up. But this move up in liquidity in blue has been coming off because the Fed is back to rolling off. In fact, on Thursday when we got the update for the week from the Fed, it was their largest balance sheet roll off since they started QT. So it tells me that Powell is wanting to unwind this bump in the emergency lending as quickly as possible. And so if he does that, in a couple of weeks, we could see this blue come back down and the market isn't going to be going up at this angle very much longer. So it's just, you got to look at all these things. Get the newsletter. It explains it all day in and day out. And that way you guys can know what to expect. I think a lot of times our macro bearish outlook is just prepping you guys for the second half of the year. And a lot of people think, well, you missed the move. No, we didn't really miss the move because you see these little circles down here. If you had the newsletter or you were in the room, you knew we were at levels that we were going to bounce. But we're not here for the day-to-day stuff. We're trying to talk to you about macro, what's going on. So you guys, because we're worried about the big oil tanker of the economy, right? It takes a while to turn. And that's what we want you guys to be positioned for. If you're worried about these short-term, day-to-day, week-to-week moves, get in the room with us, get the newsletter. And that's what that's about. So hopefully all this stuff helps you guys.
One last thing I want to mention, Phil, is that because interest rates are going up, it's affecting the duration of the bonds, and it's also affecting how long people are going to be in the homes. And that's going to roll off QT too, because the longer you're in the home, the more principal is being paid off by the people who are still paying off their notes. And the people who can't afford their notes are going to start closing those loans off completely. And that's going to accelerate QT just naturally.
Right.
And so I think people don't truly understand that this isn't going to be one of those quick V fixes.
Yep.
And it's going to be something definitely is going to be longer term. So with that, hey, I'll let you go. Thanks, guys, for listening. Have a great rest of your weekend. Have a great Easter. I'll see you guys on the other side. Phil will be with me, of course. And hit like, hit subscribe, tell your friends. We kind of want everybody to know what's going on here. And we really appreciate you listening. Thank you.
Trade Genius.